good morning, or good afternoon, wherever you are tuning in live to Mortgage Money with Shirley. It's Friday. Yes. And I've got my all white on because it's in celebration of the 4th of July. Some might call it Independence Day of America. It is 4th of July holiday weekend, y'all. I just want to say greetings. And again, like I said, good morning because it's morning here in Los Angeles. And you are on now with Shirley Nichols, Mortgage Money with Shirley. And it is my monthly podcast I do twice a month on Fridays. And tune in, tell everyone, bring a friend, bring a family member, co-worker, somebody. Bring them to the show. Check it out because if it's not for you, it'll be for somebody else. Okay? No, seriously, it's so much information that I want to share with you all that you really aren't getting when you call into a bank or you call into a loan officer or you call into a representative, an employee of some sort, and they say, "Can I help you?" They don't really mean, "Can I help you?" Right? Maybe they do, but they don't really give you the background story, the internal, the behind the scenes stuff. I'm going to give it to you. That's what we do here at Mortgage Money with Shirley. That's what we do. I'm going to give you the inside scoop, the tips, the tools that you'll need to hopefully create your investment portfolio, your real estate portfolio, so that you'll know a little bit about this thing we call mortgage lending. Okay, so again, I'm your host, Shirley Nichols. Catch this on Facebook Live, my business page, Mortgage Money with Shirley, or my personal page, Shirley Nichols. I'm on Instagram, Mortgage Money with Shirley, and you can also catch it on my YouTube channel, Shirley Nichols, Spotify. We're on there as well. You can catch this live stream podcast everywhere. So tell everybody. Okay? Happy Friday, y'all. It's your host again, Shirley Nichols, Mortgage Money with Shirley, twice a month on a Friday here at Morris Media Studios here in Los Angeles. So we are on episode 26. Can y'all believe we are on episode 26 already? Yes! Oh, before I forget, because I always forget, let me give you all my NMLS number. And that NMLS number is so very important because that's how you know I'm certified to do what it is I've been doing for over 28 years. What'd you say, Shirley? For over 28 years. So my NMLS number, just to let you know, I am certified and licensed to do this mortgage lending business. It's 105989. 105989 is my mortgage license number or NMLS number. And also, I will give you my cell phone number. This number is very important that you have that number because after today's podcast, episode 26, we're talking about bank statements and other niche programs. After today's podcast, you're going to want to call me so we can talk about it. So you can build more real estate, right? Okay. All right. So again, we are on episode 26, y'all. It is bank statements and other niche programs. And the reason why now is so important to talk about these bank statement programs is because, of course, what's going on? Interest rates are creeping up, right? Now, we did have something phenomenal happen yesterday. Yesterday's rates did drop. Right, rates went down just a little. Just a little. You can get interest rates under 6%. Conventional lending under 6%. What'd you say, Shirley? Rates dropped a tad bit yesterday, and they're under 6% on conventional lending. FHA or your government loans, guess what? What, Shirley? They're under 5%. Okay, so there's a difference, guys. If you wanted to look at smaller interest rates, sometimes payments are a little smaller. Look at the government side of lending. That means your FHA loans, your VA loans, your USDA loans. Those are your government loans, and you'll find those rates are under 5%. And I'm talking the low 4% range too. I'm talking your 4 1/8, 4.125, or your 4 1/4, 4.25. Those rates are still decent and they're good. Under 5% for government lending. Again, that's your FHA, VA, USDA. Those loans are still under 5%. And like 5%. And like I said, the low 4% range. Okay. So there's nothing wrong, and I've talked about this before on previous podcasts. There's nothing wrong with getting a government loan. In some cases, you want it. You're buying a house, you're a veteran, you want 100% financing, you go VA. And the rate is still under 5%. Now, there are some things, some nuances, and I don't know if they're really if it's really a nuisance or anything. But with VA lending, it is 100% financing. It is 100% financing of the loan amount. Okay, there are a few closing costs you'll still have to pay. All right, and I will say this: I just said that government loans are under 5%, including the VA. They're under 5%, depending on that FICO score. And I know in times past, you might have heard some rumor mill going around. Oh, it doesn't matter about your FICO score when you're doing a VA loan. Oh, don't worry about your FICO score. Well, it does matter. FICO scores matter. And the reason being, the better or the higher your FICO score, right? The higher your credit score, that higher Equifax, Experian, and TransUnion scores, the higher those scores, the lower your interest rate will be on government loans, okay? And that's why I said, yeah, VA lending, it's great. It's 100% financing of the loan amount, although you still have to pay a few closing costs, but that whole loan amount is 100% financed, and then your rate could be in the low 4% range, depending on what that credit score is. So do try to stay focused on your credit score, guys. FICO scores do matter. They do. Okay. But the reason why, like I said, I'm even talking about the rate business is because us mortgage brokers, we get excited when the rates go down, right? And yesterday was a great day to lock in your rate, secure your interest rate, and get it moving on your purchase of a home or refinancing your loan. You know, I talk about this from time to time. I am pro refinancing. Refinance if you have to with a purpose. You all will hear on my previous podcast, I often say, refinance with a purpose. There's nothing wrong with doing a refinance cash out deal if you're refinancing with a purpose. You want to consolidate debt. You want to build on a pool. You want to add square footage. You want to do an ADU, an accessory development unit where you've got a tenant or a loved one relative, might call it a granny suite in the back of the property where you've built this extra unit, okay? Those are the things that you're looking to do for refinancing of cash out when rates are high. And they're not even high because you know me, I say higher because they're not high. They're probably right where they should be. And I know I say that on these podcasts and you're probably thinking, surely, but no. Rates are probably where they should be. They are higher than what they used to be, but they're probably right where they should be. Okay. All right. I said it, I know. But again, cash out refinance with the purpose. So now, that's why I brought up, refinancing and the rates is because yesterday was a great day to get it moving. All right. If you have any questions, comments, or concerns, leave them on the Facebook page. I will get back to you or DM me, direct message me, or I'm going to give you my cell phone number at the end of this podcast. So do stick around and know that you can contact me and I will get back to you and answer your questions. But again, yesterday was phenomenal. Okay, so let's jump into episode 26, guys. The bank statement program or other niches that you might want to talk about. Bank statement programs, they're here. And I know that sounds kind of crazy, kind of funny, but they did kind of take a back seat when the market crashed. When the market crashed in 2008, a lot of programs started, restricting their guidelines, starting to become, more conservative. They tightened up a lot of things and they did away with a lot of programs. And some of the programs, i.e. the bank statement program, kind of went to the side, went to the back of the line when the market crashed. But now we're seeing this popular trend. Bank statement programs are here. are, guys. They are. And they're even here with A-paper lenders, right? And I know it's kind of cliche. We don't really like to talk about it. It's kind of taboo to talk about A-paper lenders. However, even the A-paper guys, those ones that we call like in the box or cookie cutter deals, or they're just A-paper, where they've got the great FICO scores, great income, great debt to income ratio. These lenders at one point in time didn't do bank statement loans. They didn't exist with them. They were like, no, we're done with this. As soon as the market crashed, we don't want it. These A-paper guys, because, for whatever reason, they didn't want them. Now, and I can go into a whole background of why they didn't want these bank statement programs, but that's another topic, another podcast. What I'm saying is, even the A-paper lenders, the lenders that have the lower interest rates, that have the higher loan amounts, and their thresholds are there in place that you can actually obtain these thresholds and can meet them, and their guidelines are kind of looser. These A-paper lenders, guys, with these better interest rates are doing bank statement programs. That's huge. Okay, so I'd like to talk to you about bank statement programs. Bank statement programs, what is that, Shirley? Bank statement programs, it literally means just that. We use your bank statements to qualify you for income, right? And it's for the self-employed client, okay? You're not going to be a W-2 wage earner with the bank statement program, right? We're still going to use your W-2s and pay stubs. However, for that self-employed client, the guy that owns the barbershop or the car wash or the dry cleaning business, the mom that owns the daycare business, or the mom that owns a hair salon. These self-employed clients are who we want on a bank statement program. So what does it mean? Bank statement program, we're going to use that income that you're dumping into the bank monthly. We're going to use that income to qualify you to get a home loan. Or maybe you want to refinance because you're already an existing homeowner. So with the bank statement program, we literally will ask you for either 12 monthly bank statements or 24. And now we have lenders that really don't need all of the pages of the bank statement. I'm going to ask for them, but they're not going to scrutinize and look into every single page like times prior. Years prior, they would ask for, if your January bank statement was 10 pages long, they want all 10 pages, right? If your February bank statement was 12 pages long, they want all 12 pages. Now, we have lenders that will literally only take a look at that first page that says monthly deposit was XYZ, right? They'll look at that monthly deposit on that first page or wherever it may be on the second page, but they're looking only at that specific page that says total deposits, right, for that month. And they're going to do that on 12 different months or 12 different bank statements. But just that one page. Years before, they would scrutinize every single page of that bank statement, right? They would look at page 5. Oh, you had a monthly deposit of $10,000, but your other deposits say $2,000. Where'd you get that $10,000 from, right? Most lenders used to look at these bank statements and really scrutinize. Where did you get this deposit, that deposit, this deposit, that deposit? They really did. But now I have a few lenders in my arsenal that really will only look at your total deposit for the month. Now, of course, there's a couple of layers of risk that are involved with that. So there's some questions that they may ask, and then they may need the entire bank statement. But for the most part, initially starting out, they will look at that first page or whatever page that says total deposit for that month. They will look at that page only. Now, what do I mean about there's some layers of risk and there's some questions that they may ask? Well, here's the scenario, and this is just how it works, guys. The bank statement program in itself is already a high risk program, right? They already call that a riskier program because it is. It's not a pay stub. It's not a W-2. It is a bank statement that deposits tend to do this, right? Normally it's not consistent across the board every single month. So having said that, those programs are a little bit more risque. So what happens is if you have, let's just say it's January, right? And you want to do a bank statement program. So the lender says, hey, I'm going to need your January 2021 statement all the way to January 2022. Remember, most of them need 12 monthly statements. So they're going to say January through January. All right. And your average, your more consistent deposit is $10,000 a month. However, somewhere around April or May, you had a $30,000 deposit. So now what happens with that April bank statement that says $30,000 for the monthly deposit, that statement, they're going to say, you know what? No, I'm serious. Some underwriters really do. They look at that statement. Okay. For those of you all who are watching this podcast and not just listening, I'm holding up a paper like it's a bank statement and I'm kind of reenacting what these lenders do. But nonetheless, right? They're looking at this bank and say, what is this $30,000 monthly deposit for the month of April when every other month you've done a $10,000 deposit, an $11,000 or a $9,000, somewhere in the range between $9,000 and $11,000 is normal and routine for your monthly deposits. But in the month of April, you have a $30,000 deposit. Now, what does that mean, Shirley? Well, the only thing that's going to happen is they're going to say, you know what? We're going to need all of the pages for that month of April. In order for us to count this $30,000, if they do count it, and more than likely they won't, but they'll look at the statement and they'll say, oh, your normal deposit, we see that here, it's $9,500 or 10 grand. We see that. But this other $20,000 says lottery winnings. Yeah, no. They're going to back that out every time because the lottery winning is not something that's consistent, right? It's a one-off. It's an isolated situation. So they're really not going to count that $20,000 lottery winning. You understand? So anytime on that bank statement, if the deposits are sporadic, they're all over the page, or they're not consistent, they really will ask you for all of the pages. Here we are now in the 2022 year. We're trying to, make everything a little bit seamless, a little bit paperless, a little bit, easier to look at and manage. So we don't want all this paper running around. So we'll always ask for that first page. However, again, if you have that deposit that's a little sketchy, that's a little bit more than the average, they are going to ask for the rest of those pages of that bank statement. And then if that deposit is a one-off or an isolated situation, like I said, I don't know, your dog won the best dog in show and the winnings for that was 20 grand. They're going to back that out, okay? That's an isolated one-off situation that they're not going to count. So don't think that you're going to boost your income or your purchasing power to get a higher sales price, a higher loan approval because you have, $30,000 for the month of April and you think they're going to average it in. They will not average it in. Now, there are some cases that they will average it in, right? If that $20,000 was, something that, child support in arrearages or something that you got paid out and then every month you're going to have child support coming in, something like that may be counted, but it's very rare that they're going to count those lump sum deposits unless it really makes sense. And it's something that will, typically continue, like I said, like child support payment or spousal support or alimony, something like that. Okay. So bank statement programs are here, right? They're going to ask for 12 monthly statements, typically the first page that says the total deposit for the month. And they're going to average it in, divided by 12, and give you this number and say, this is where we're going to say your income is at on a monthly basis. And then they still have to take in consideration all the debts that are on the credit report. And we've talked about that from time to time on other podcasts. All the debts that are on the credit reports, they're also going to take those numbers, add them up, divide it by the income, and they're going to say, boom, there's your debt to income ratio. Bank statement programs are here for the self-employed client. It is a great program. Now, earlier in the podcast, you heard me talk about how rates went down yesterday. They went down just by a smidgen. They're under 6%. They're under 5% for the government loan. I talked about that earlier today because it brings up this next point. On a bank statement program, on a bank statement program. You heard me say it's a riskier loan. With risk, there's more interest rate. There's a higher interest rate. There's more hits to the rate, what we like to call hits. They're just added more money, basically, more cost to you if you want to do this loan program. And like I said before, I'm a champion of the refinance. You're a business owner. You want to expand your business. You want new equipment. You need, I don't know, you want to modernize your business or update it, whatever you want to do, and you need some money. Refinance and pull the money out of the property that you have built all this equity with and use it. It's tax deductible, right? So you get this money to put into your business. You're reinvesting in yourself. I don't care if it's your house or a business. But for you self-employed clients, use the money, use the equity when you have it. I was talking to another colleague, and he said something so profound. Use it or lose it. You know, these values of these properties have gone up during the pandemic. Use your equity. Use it or lose it, right? Use it and then reinvest in your business or reinvest it in your home. It's there, guys. But we're talking about interest rates, and I know you're going to say, well, Shirley, what's the rate? Bank statement programs, okay? Bank statement programs, those interest rates start at 6.25%, and they go up from there. 6.25%, guys. And they go up from there. However, tax deductible, and you're reinvesting in your business or your property, right? So this money is yours. Use your money and reinvest it in yourself, right? Whether you take out the money to go purchase another property, an investment property, a rental property, or you reinvest it into your business, use it or lose it, right? And I know that you might think, well, it's over 6.25%. But again, I don't know where you all think you're going to get money, hundreds of thousands or tens of thousands, for less than 6.25% when you're self-employed and you're using a bank statement program. So when you call Shirley, hello, hi Shirley, I heard your podcast. I want to do the bank statement program. And when I hit you with the 6.25%, don't get upset, because I'm telling you now, that's what it is right now. It starts, and that's the key word. It starts at 6.25%, because why? Let's talk about it. Get out my notes that I hardly ever use. But I want to make sure you understand. With some of these A-paper lenders, they go up to $3 million, okay? Up to $3 million. FICO score needs to be a minimum of a 640. They will also go 90% loan to value. What does that mean, Shirley? Basically, just to make it real simple for everybody, if you got $1 million property, they'll go 90% of that or give you a loan amount for $900,000, okay? Just 90% of whatever the appraised value is. That's the maximum loan to value or the maximum LTV, 90%, okay, on the bank statement deals. You only have to have a 640 FICO score, and they go up to $3 million. Your debt ratio, okay, we talked about that briefly. The debts, whatever's on the credit report versus your income, the debt to income ratio has to be under 43%. 43% and under, and you can use your bank statement program if you're self-employed. Self-employed, 640 FICO, loan to value 90%, debt to income ratio 43% or under, up to $3 million, folks. Easy, right? However, might I stress to you, if you call me and that FICO score is a 640, your rate will be higher than a 6.25. It will be, okay? But as I've said in other podcasts, as rates go up, rates will come down. So you may have to hold on to this 6.25, or if your FICO score really is a 640, you may have to have a rate closer to 7 and just hold on to it until the rates drop, maybe in about another, and you heard me say this before too, and I don't have a crystal ball. Don't call me because I don't know, but I'm just saying, it seems that history kind of repeats itself, and when the rates go up, they last normally about a year, year and a half, and then they're going to go down, okay? And like I said, don't quote me, I don't know, but just because I've been in this business for about 28 years, I've kind of seen the cycle, the trend, right? Okay, again, bank statement programs are here. Self-employment, self-employed client, 640 FICO, up to $3 million, 90% loan to value, 43% debt ratio or under. Bank statement program, folks. Okay? So don't get squirmish because you're self-employed and think, I can't get it. I can't get this money because my pay stub is non-existing. You can get it. Get a bank statement. 12 of them to be exact. Okay, and then, like I said, every now and again, there are some cases where they'll ask for 24 months, okay? So just kind of keep that in mind. Either they'll ask for 12 months or 24 months. That's the bank statement program. Now, let's talk real quickly because my podcast is coming to an end. I have this trouble all the time. I do my monthly podcast twice a month on a Friday, and I always go over my time. It's a 30-minute podcast. I don't want to hold you guys up. I don't want to snore you to death, but I do want to give you all this valuable information. And most of the time, I'm going over my time. So let me just speed this up real quick because the next, guys, if you're watching me live, you'll notice I'm holding up two very great pieces of information. They're flyers. They're flyers for something that I have not talked about on any of my previous podcasts, but they're talking about the California Association of Realtors, better known as CAR. They're offering their Housing Affordability Fund. What is that, Shirley? Yes, guys. Here in the state of California, if you are a licensed real estate agent and a realtor of the California Association of Realtor Board, me, if you are, you have the ability to have the client that you're working with, your buyer, try and get them eligible to qualify for their closing costs up to $10,000. Huge. CAR, or California Association of Realtors, CAR, they have a whole fund that they said, and I quote, "We have successfully distributed near $400,000 in our goal toward $1 million for the year." Guys, we're only in the 7th month of the year. There's 5 more months that they want to get rid of $1 million. They've already distributed $400,000. They got $600,000 more to get rid of in 5 more months. It took them 6 months, 7 months to get rid of $400,000. And they still have $600,000 left to give to you. Yes. So if you're a buyer in the Los Angeles County area and you need a real estate agent, hello, and you need a realtor, Shirley, if you need someone, Shirley Nichols, to represent you on buying or selling your house, but specifically, a buyer, talk to me, call me, and I'm going to give you my phone number as I mentioned, but call me so that I can get you or try to get you eligible for this Housing Affordability Fund. There's $600,000 left to give away, and they're giving up to $10,000 per eligible buyer. So let's talk about this eligibility because this is really important. Listen up. In order to be eligible for this Housing Affordability Fund given by CAR, you have to have a realtor from the California Association of Realtors. You have to have a realtor that you're working with as a buyer to represent you when you're buying a property to offer this program to you. So the eligibility requirements are this, and it's very important, okay? They are offering it for the clients whose income is the median area income that meets or goes up no more than 120% of the median area income. What does that mean, Shirley? For Los Angeles County, the median income for Los Angeles County for the year 2022 is $91,000. Okay? The median income in the Los Angeles County area is $91,000 for the year 2022. The reason why I say the year is because every year that changes, okay? Right now, for the year 2022, if you are making $91,000, okay, not to exceed $109,000, the program will allow for you to have either that $91,000 median or lower, or it will allow you to go 120% over that $91,000, okay? So you can go over 120% or be making $109,000 or less, and you qualify for these closing costs. Well, again, you may or may not. We'll have to look into that. But what I'm saying is, it's better to try to see if you can get your closing costs up to $10,000 paid for by CAR's Housing Affordability Fund. It's better to try to qualify for that than not. Now, there's also a couple other requirements that you must meet. You also not only have to meet that median income threshold, not to exceed 120%, but you also have to be one of the clients or home buyers from an underrepresented or underdeserved orientation. What do I mean by that? Well, of course, minorities. Okay. Minorities. They're also talking about, believe it or not, they have on this list people of color and homelessness. Also people with disabilities, physical or mental. Also, they're talking about the LGBTQ community. All of these different underserved or underrepresented, all of these areas of eligibility will fit this requirement, okay? And we can talk about that because they've got a whole list of, impoverished areas. I mean, there's a whole list of people that are somewhat eligible to get this housing fund or get their closing costs paid for up to $10,000. But again, meeting the median income and underserved areas, communities, again, like I said, minorities, people of color, LGBTQ communities, homelessness, mental and physical disability. Those are the clients that they're looking for to help fund these closing costs up to $10,000, okay? So make sure you give me a call and we'll talk about it and see if you qualify for that, because that's huge. And that's what I wanted to tell you today. I'm so excited to bring this information to you. So again, guys, I implore you to call me. Let's talk about these bank statement deals. Let's talk about this housing fund. Let's talk about your real estate portfolio. Okay, it's your girl, Shirley Nichols, and it's Mortgage Money with Shirley. I'm on twice a month, almost every other Friday, bringing you this nice, lovely, educating 30-minute podcast. So I hope you all have a great holiday weekend, and I'll see you next time. Thanks for tuning in, and here's my phone number. I know you've been waiting for it. 818-720-7575, 818-720-7575. Give me a call. Let's talk. And I'll see you soon. Have a blessed one.